Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin, the Chief Currency Analyst here at HYCM. I'll be taking us through this coming session, as well as letting us know some of the key market events that we have coming up this week. It was a bank holiday here in the UK, so I wasn't able to do my usual FX week ahead on the Monday, so we'll cover that as part of today's workshop as well. Just giving folks a moment to come in. Please let me know if you have any problems hearing me. Just type it in under the question panel and let me know if you can't hear me. That would be helpful to know that you're getting me loud and clear. So just let me know that's if there's any problems there. I'll just have a look. Yeah, I'm sharing the main screen and I think everyone can hear me okay. So if you've got any problems, just type it in the question panel and I can see if I can help you from here. Don't forget that as we start, the disclaimer, we'll be looking at a variety of different options, currency pairs, different trade levels, and it's just to make clear that the whole idea of the workshop that's provided is not to be a signal trading service. The idea isn't that you go and trade the currency pairs and the signals that I highlight to you. The idea is that this is to help your education, so you can learn to make more informed decisions at the market, so that you come to understand which currency pairs are most likely to move in which direction by the process of the skills that we learn in this workshop week by week. So just to make sure that that's clear. The key thing is about education to inform your decisions so you can make responsible decisions in your trading. Also going to have a little outline of the session ahead. Don't forget that the outline is in the handout, and the handout can be found underneath the section of your GoToWebinar control panel, which says handouts, and it says handouts 1 of 5, and there's a file titled Workshop Guide May 28. It's a PDF. You just click on that, you'll open it, and you'll get the guide for today's session. And the whole idea of this guide is to be a kind of skeleton or an outline for whenever you come to your trading desk, what are the key components you need to look at. And I've put them as looking back, looking forward, looking at the charts, looking at your risk, and looking at the outcome of your trade. And that's really a summary for you, printed out, put it by the side of your trading desk, and you can use it to make trading decisions as you go forward. This week will be a little bit different to this, just because we're also incorporating the FX week ahead into our usual 1-hour session. So just to be aware of that. Otherwise, just keep it open, and we'll be, use it to refer to during the session. Special topic that we have today is, oh, hi Nadir, good to see you. Hi Van, thank you Nadir for mentioning the questions. I know you can hear me okay. Ifam, Yulia, Antonio, that's great. Yeah, super. The special topic for today is how to use trend lines for entries and stock placements. For those of you who've been following these workshops for some time, you know that I don't major on the technicals. I tend to major on the fundamentals and then leave you guys to apply your technical analysis to the fundamental outlook. Today we'll be just having a little look at trend lines. They can offer very simple places to enter and exit our trades, so it's just worth having a look at them. They can be helpful in your trading, so we'll take a little look at those later on in the session as well. The handout for the session I've already pointed out, and if you've got any suggestions for future topics, just email me here, giles.coughlin@hycm.com. So when I say future topics, I mean these special topics that I'm using. We've done a whole range of special topics over the course of, quite a few months. And so if there's a special topic that you would like covering, just email me. Maybe it's option levels, expiry levels in the markets. Maybe it's risk currencies. Maybe it's bond yields. Whatever it is, just email me and we can look at it for a special topic at one of the sessions that we have. So without further ado, look at your handout, and we'll be starting by looking back. And what we're going to be doing now, particularly after a bank holiday, I've just come back after a nice weekend with my family, and so it's important that you really key straight back into the market. What you really want to do is you want to find out what's going on, what's moving the market, what key drivers are happening, and that gives us sentiment, and that tells us what pressures are on which currency pairs. And of course, what we're always looking to do, we're always looking to pair a weak currency against a strong currency. So that's the purpose of our analysis, is to find, which currency is strong, which currencies are weak, and preferably pairing them up against each other to give us the best potential outcome of the trade moving in our directions. So we're going to start by looking back. And at the moment, President Trump is away. He's out of the US and he's traveling, and he's at a trade summit in Japan. And when he was at this trade summit with Japan, so I'll just make this a little bit clearer, he was having a press conference yesterday evening, my time, and at the press conference with Japan's President Abe, Trump admitted that he's not ready to do a deal with China yet, okay? So all of a sudden, the market was a little bit nervous because previously Trump had been saying, had been giving calming remarks to the market that there would be a trade deal done. He expected it to be done very soon. And then yesterday he said, well, he's not ready to do a deal with China yet. The key thing for us to remember, really, as we're listening to this rhetoric between Donald Trump and China, is that Donald Trump really does want to fight a trade war against China. He is really focused on doing that, but he doesn't want to, as I put it, spook US stocks, because it was December 2018 when he came in very hard against China, announcing the tariffs, and there was big declines in the S&P 500, in the Dow Jones, in the NASDAQ, big falls in US equities, because the market was clearly worried that global growth was going to slow down. US and China, for those of you who've been following me for a number of weeks, know that they constitute nearly 40% of the world's global GDP. So Donald Trump is going to play this game. He wants to fight the Chinese on the trade front, but if he gets too aggressive, then he'll hurt his own stocks, and he doesn't want to see US stocks fall. So expect this continual kind of dialogue to be happening with Trump saying, I want to hit China. Oh, I'm confident we'll get a deal done. And then he's going to go right back to saying, I want to hit China. So be careful. The risk sentiment is very fragile, and risk is tilted at the moment to being risk off. We're going to be constantly returning to a risk off a sentiment and mode. So it's a sell the rallies of the US dollar Japanese yen pair, because we're looking at the moment to keep buying the yen on pullbacks. Okay, that's my bias to the market at the moment. Just to remember that this US-China trade war is rolling on. There was some interesting comments overnight from Guo Shuqing, the head of China's banking. Now, he gave a warning speech. And in that warning speech last night, what he was saying is that he is ready to punish people speculating on a short yuan position. Okay, so looking at the yuan, it's weakened 2.6% this month. So let's just show you the chart here. I'm just going to call up the US dollar Chinese yuan chart here, and you can see here, this is the US dollar Chinese yuan chart. It's weakened 2.6%. So you can see since the latest trigger in the trade war, that the one's just weakened. That's US dollar Chinese yuan up is the weakness in the yuan. You can see it's just weakened, and it's gone through these pivot points, 1, 2, 3, 4, 5th, finding some support here about 6.9. Now, the comments that are really worth being aware of is the he has said that people who are short yuan are going to be punished, and he can punish speculators heavily. Now, I just wanted to remind ourselves that China wants a stable yuan. They don't want lots of short yuan positions. They want to have a stable currency, and they see it as a very limited benefit for their exporters by having a weak yuan. So they're not thinking, oh, this is going to be really helping us with the trade war at all. They much prefer a stable currency because it puts them on the map as, a superpower, a global power, one that doesn't have huge movements in the currency. And of course, because if the currency is moving huge volumes, then you're going to have capital outflows from the country. So what the Chinese really want is this stable exchange rate. And remember, they can defend this exchange rate. They have done it before. So for example, in January 2017, China cut their cash supply rate in Hong Kong, and they sent the currency's deposits rates to record high. Sorry, I've just misspelled that. Deposits rates to record highs. So they've done this before in the past. And what rumors have been circulating that it's the 7.00 level that will be defended. So I'll just show you that level on the chart. Just see. Okay, I'll just call it back up on the weekly chart, will be most helpful. Yeah, I've just marked roughly that 7 level here. Okay, so this is on the weekly chart, and you can see this 7 level here. The rumors are that this is where the Bank of China will be actively and potentially aggressively defending that level. They don't want to see the yuan weakening above 7. Okay, so that is kind of the rumored line in the sand. So that's just to be something very aware. Currently, it's at 6.911. So the yuan's currently just about 80, 90 points short of the 7 level. So that's something to be very aware of at the moment. And you could expect to find the level 7 as a first level of resistance. So I would expect to see that level hold on a first test. Okay, so this is potentially any return up to that level is potentially a short, you see, and stocks could be placed just above the 7.00 level, 7.1, maybe above that resistance point. 7.2 would be a good level, or maybe much tighter, depending. So again, that's not trading advice, but that's just seeing a potential opportunity, because the Chinese bank have said that they will punish people who are short yuan. So they are indicating they will use policy to strengthen yuan. And the 7 level is being rumored to be an important level. It's also a key overhead resistance level on the weekly charts. You can see there's multiple factors that the US dollar Chinese yuan level should hold at that 7 level at a first test. So that's just to say, that's the technical picture. We've got the fundamental picture. It's all part of this US-China trade war rolling on. But needless to say, one key lesson is, remember the Swiss National Bank, they said they would defend the 1.20 level on the euro-Swiss franc pair, and they actually removed that peg, and that peg was removed in January 2015. But remember, for about 4 years, 3-4 years, that peg was guarded. So we just got to keep those two different narratives in our mind. One, a central bank can't hold a level forever. We've seen that before, and we'll most likely see it again. But at the same time, a central bank can influence a certain level, will influence a certain level, and there are potential opportunities there. But the key aspect to remember, as with always trading, is never over leverage. Do not use more leverage than you should be using. And I personally don't use leverage. I only use leverage very rarely. So what it means is when an unexpected event happens, or you get a sudden, removal of a level by a central bank, you're not going to end up losing huge chunks of your capital. It's very hard to make capital, and it's even harder if you've lost great big, sections of your capital through using over leverage. So just to be aware of that. But for now, US dollar, Chinese yuan, I'm expecting the 7 level to hold on a first level of resistance. Okay, so that's the US-China trade war. Again, the key pairs to be looking at is US dollar Japanese yen and Australia dollar Japanese yen. The Australian dollar Japanese yen pair is very sensitive to risk. So I'll just briefly show you that. Let's go on to the daily chart. Just get rid of some of this. Just get rid of some of the. There we go. So just quickly call it up. You can see as we've been having this US-China trade war going on, we can see that the Australian-Japanese yen pair has fallen through 1, 2 pivot points, briefly testing the underside of the second pivot point and stuck between 2 pivot points at the moment. You've seen this, downtrend through this key 78 level, that key support level, and price is moving downwards. Australian-Japanese yen, this is a pair that's very sensitive to risk. When in a risk-off market, you're going to see the Australian dollar be sold, Japanese yen bought, which is short Australian dollar Japanese yen. So that's just one pair to have in mind. Now, going on to European elections. Now, I was looking, with interest at the European elections, because what I wanted to see was there a rise in right-wing and populist governments that were going to make the Eurozone as a whole less viable? That was the fear going into the European elections, that nation states were becoming more and more disenfranchised with Europe, and would anti-European parties be elected to go to the European elections. Now, this is how it turned out. So these were the seats before the elections on the left, and these were the seats after the 2019 election results. And there's going to be a number of key findings for us to look at here. The number one first finding is that European voters, they're clearly engaged, and the turnout was the highest since 1994, with an average of just over 50% of voters turning out. Obviously, it was very different in the UK. I think it was just under 40% in the UK, but that's to do with Brexit and isn't particularly a surprise. But generally, people turned out very well. Now, the 2 biggest voting blocs lost their majority. Now, the 2 biggest voting blocs are the centre-right, they're called the European People's Party, here EPP, and the Socialists and Democrats Party, the SD. So these 2 parties, these were the biggest parties in the European elections, holding the majority before the election. Now they've lost their majority. So we're seeing a move away from major party politics, and this is reflected throughout many nations at the moment. We've seen this reflected in Britain with the European elections and the local council elections. There's a move away from major parties dominating the political landscape, and we're seeing you can see here there's the votes are being spread out more evenly across the different voting blocks. So this is telling us that going forward, making decisions for the European Parliament is going to be much harder. Because it's going to be harder to get majorities. It's also going to be harder to get agreement. So there's going to be more kind of what's the word? There's going to be more coalitions forming. They're going to be more, difficult. So, like the Green coalition, so you could have a Liberal Party coalition with one of the major parties. That's going to obviously make decision making more complicated and difficult, and it's going to raise new issues as well. Thirdly, that was the point I just made. So that will make decision making harder. Fourthly, although Eurosceptic parties gained seats, the feared increase did not occur. So this means that the influence of these parties is likely to be only locally felt. So, you know, the right-wing nationalist movements, yes, they gained seats, but it wasn't in huge swathes. So that, you know, any feared influence that they could have, the undue influence is gone to the background. Let's look at the euro US dollar daily chart here. Just going to pull up the euro US dollar daily chart. You can see, there we go. So price is just sitting underneath 1.12 on the euro US dollar daily chart, and we can see price is just sitting underneath the pivot point on the daily chart. So we can see that the euro US dollar pair is in a downtrend. You know, we can see that, you know, key overhead resistance is at the 1.2 level. And then here, just above the resistance 1 level and the 100 EMA level, 2, the more key overhead resistance point. As long as we're staying below 1.1200 on this pivot point, you know, I favor more downside. If we break above, then I fancy a test of the 100 exponential moving average. The key kind of thing at the moment is the slowdown in the Eurozone, the concern over German manufacturing, and the big picture within Europe at the moment is that, yes, there has been a slowdown, but it's not a nosedive, and there is some tentative signs of recovery, but longer term, the euro is likely to remain pressured for now. So just got to be aware of that larger narrative that's playing out on the euro. And using these key technical levels at the moment. Brexit, May's departure, and the European elections. So just worth having a little look at how the European elections affected the UK government, particularly with regarding to Brexit. Now, with the European elections, there's one party that's led by a very charismatic leader called Nigel Farage. And Nigel Farage won 31.6% of the votes in the European elections in the UK. And that is all about leading the UK out of Europe. That's what he wants to do. That's the whole focus of the party. Now, previously, if you see the vote share change from a previous year, you see previously UKIP had won a huge share of the votes, and you know, I think around a 27% of share of the votes. Now UKIP at that time was led by Nigel Farage, who now leads the Brexit party. So really, and as you're looking at this, it's really one very charismatic leader who is determined to bring the UK out of Europe, and many voters are rallying behind him at the Brexit party because they want to see him hold the UK government accountable to getting Britain to leave the European Union, which, as it stands, Britain has not been able to do. And it was Theresa May who ended up, you know, standing down because she wasn't able to deliver a Brexit. So that's a key change. You can see again, you see here, the Labour and the Conservative parties falling down. You can see the Green Party and the Liberal Dem Party and the Brexit Party taking more of a vote share. So you can see this changing political landscape here in the UK. And this just shows how the Tory and Labour vote share has fallen. So traditionally in the UK, look, you know, nearly 80%, in the 80s, you know, nearly 80% of all votes were either Conservative or Labour. And what you can see is there's been a steady decline in Conservative votes, a steady decline in Labour votes. And in 2019, you can see that European elections have historically low votes for the Labour and the Conservatives. So they don't even account for 25% of all the votes. So that really does show you how how badly the Labour and Conservative governments have done in the UK. And as a result, partly because of this, Theresa May announced her decision to stand down last week, seeing how difficult it was for her to deliver Brexit. And she stepped down. Now, she's due to step down on the 7th of June. So at the moment, on the Brexit front, we're not expecting much news or much movement. The leader that's set to replace Theresa May is a man called Boris Johnson. Now, he's a clear front runner, and he's got 39% of the vote to take over as the new Conservative leader. Now, Boris Johnson is in favour of us leaving Europe, and he's in favour of a hard Brexit if necessary. So with the appointment of Boris Johnson, if and when that happens, it will result in more uncertainty regarding Brexit, and people will be more factoring in the idea of a hard Brexit. Now, a hard Brexit is when Britain just leaves without any kind of deal, and that date to leave at the moment is the 31st of October. So as things stand, unless a deal is done, or unless the Eurozone extends the withdrawal period for the UK, it stands on the 31st of October, Britain will leave Europe. So at the moment, the chances that I saw, the probabilities are set at 25% chance of the UK leaving Europe without a deal. That's a 25% vote. So at the moment, again, the pound US dollar pair, we'll just look at that, remains a sell on the rallies. Okay, so we'll just have a little look at the pound as of late. I'll just pull up a quick chart on the hourly. Okay, just bear with me. I'll just take a quick screenshot of the pound US dollar hourly chart, and you can see that over the course of this month, the pound has just generally been sold off. Any rally has been sold. Okay, we can see that the pivot points have provided really simple places to trade from. Pivot point, trading down to that pivot point, down to the next pivot point, down to the next pivot point, up to that pivot point, down to this one, and price is currently just returning up to this pivot point around the 1.27 level on the 1 hour chart. So as I said, the pound US dollar pair remains a sell on the rallies. So key places to sell from, again, would be this current pivot point here, with stops placed just above the 200 exponential moving average. You can see that the 200 exponential moving average price hasn't gone above that since the 13th, 14th of May. So there's some really, good strong defense of those levels. And this pivot point here with the 200 exponential moving average offers a good potential place for sure. Again, get above this level and above the 200 exponential moving average, then the next target will be looking at this 1.28 level just underneath this resistance zone. So get and stay above. We're looking at 200 exponential moving average on the first port of call, then then 1.28 above, or alternatively stay below this pivot point. We're looking at a retest of these lows and then looking at a retest down toward 1.26. So that's the sort of a technical snapshot as the pound US dollar pair. But remember, it's it's going to be probably not much going on for the next couple of weeks Brexit wise, because we're in that limbo period while we're waiting for Theresa May to step down before Boris Johnson takes lead of the Conservative Party, if indeed he does win the Conservative Party election. So remember, this is not a general election. This is just an election within the Conservative Party to see who will take over as the leader. Another chart I wanted to show you guys is a key divergence that's taken place recently. And this key divergence is between iron ore and the Australian dollar. Okay, they have diverged. Now, usually you can see the Australian dollar and the prices of iron ore usually move in tandem. Okay, you can see that from 2014 to 2015, you have them moving, very similarly. So when iron ore prices go down, the Australian dollar prices go down, and vice versa. Now the reason is that Australia is the world's largest exporter of iron ore. In fact, around 50% of the globe's entire iron ore exports come from Australia. So that's why it's such a key link between the two different currencies. When iron ore is going down, Australian dollars going. When the price of iron ore is going up, that naturally lifts the Australian dollar up with it. So they're very closely correlated. The other big exporter is Brazil, and between the two of them, they make up around 70% of the world's entire iron ore global exports. So this relationship at the moment, you can see, has suddenly moved, and it's what's called a divergence. Normally they work together, but all of a sudden iron ore prices have been increasing. This is the blue line on the chart here. These are the iron ore prices, but the Australian US dollar pair has been falling. You see, normally they've been working in tandem together, and even here, either they diverged briefly out of sync, didn't they? But then we saw that the iron ore prices fell back down to catch up and to move back into correlation with the price of iron ore. Now, that's what we're seeing in a very, very similar pattern we're seeing happen now. So why has this relationship between the Australian dollar and the iron ore broken down? What is between? Why is this happening? Why is iron ore prices continuing to reach record highs? As you can see, it is. It's multi-year highs it's been reaching, and the Australian dollar is touching towards multi-year lows. What's going on? Well, this year there's basically been a series of supply shocks for iron ore. And Brazil Mining were hit by one of their top mining companies. I think it's called Vale. I may have got that wrong, but they have been hit by a terrible accident. I know this is right. Sadly, resulting in the sad loss of 300 lives. And as a result of this accident, some big questions have been asked about the safety of the mining outfit. And as a result, supply has been hit. Brazil hasn't been able to produce as much iron ore as it had been producing, and it's quite a few million tons that it's short. I can't remember the figures off the top of my head, but I think between Australia and Brazil, between the two of them, for the first 3-4 months of this year, the price, the exports of iron ore is down, I think, about 37 million tons. So it's a large supply shock. So of course, as you guys know, when supply is limited, price rises. So that's one of the big reasons why we've been seeing the rise in iron ore prices, because not so much iron ore has been able to get into the market. Now, similarly, in another interesting note, China's iron ore imports have dipped. Now you can see here, this is China's imports. Millions of tons, and they're normally importing around 80 million tons, clipping to 90 and staying generally well supported above 70 million tons. However, in recent data points, we've seen that China's iron import has dipped, so there's less demand, right? We're starting to get the clue now. There's less demand. So what this means is that if once Brazil's output recovers, that means that supply will flood back into the market, And when supply floods back into the market, but demand has dipped, it means we're likely to see the relationship between iron ore and the Australian dollar return. And when they return, it's going to be the price of iron ore that's going to start moving down back in conjunction with the Australian US dollar. So the warning here is that iron ore prices potentially look very overpriced at the moment. And the likelihood or the possibility of iron ore being sold are very high as long as the supply levels increase and global demand decreases as well. Okay, so that's just something to be aware of. It's something for you to look at, something to keep on your radar. We'll be trying to keep an eye out for this as well. If you suddenly see the US-China trade war get a lot worse, then we can expect to see more pressure on iron ore for the reasons that I've shown you in this graph here, as China, who is the world's biggest importer of iron ore, as their demand dips. Okay, I hope that's clear, and just have a look out on that relationship going forward. We also saw the Italian debt issue raising its head again. This is something that the market's been returning to a few times. It's here again, and the Deputy Prime Minister Salvini from Italy said that EU rules should be aimed at keeping deficits below 3%. So just this is likely to weigh on the euro pair as well. Now let's also have a little look at the week ahead. There's not a whole load of key data points out this week, but we're starting with one that's of interest coming up overnight. There's quite a lot of data out for New Zealand, and we've got quite a few key data points out tonight. Now, the data point that I'm particularly interested in is the ANZ Business Confidence Data Report. Now, if you just look at this following chart, you can see this is the business confidence data, and we can see that from really end of December, particularly going to the end of last year, we started to see some really low data points for business confidence. That data point then was nearly -50 at the end of December 2018. We've seen a slight pickup in the business confidence level, and is expected that level may pick up again, because there were some plans by the New Zealand government to increase some capital gains tax. Now that increase or launch of the capital gains tax has been cancelled. So expecting to see this number potentially ticking up. But if it doesn't, that's going to be very negative for the New Zealand dollar, especially as some people are expecting the business confidence levels to rise. Remember, alongside this business confidence, we've got Governor Orr speaking before it and Governor Orr speaking after it. And we have the Reserve Bank of New Zealand's financial stability report. So this is potentially a big mover for the New Zealand dollar, so be aware of it. Now, if you happen to be up, that business confidence report is potentially market moving. So if you saw, -49, -50 again, then the New Zealand dollar will sell off quite quickly and quite heavily. So just to be aware of that. And conversely, if you see a good recovery, plus, -11, -20, even a plus figure, then we're going to see some strong recovery in the New Zealand dollar. Whether it would last or not, I'm not sure, but just to be aware that this business confidence data point is going to be influential and potentially market moving. Now, going into tomorrow, Thursday, again, there's some more New Zealand data released, the annual budget release, and there's a US dollar preliminary GDP level. The data point that I'm really interested in, is for Wednesday, is the Canadian dollar rate statement. Now, the Canadian dollar has, Governor Pollock's last rate statement was a little bit more negative on the Canadian dollar than the market was expecting. There were some reasons for him to be relatively optimistic. He wasn't. He did say, however, during the course of that meeting that it's possible his outlook and the forecasts were a little bit too gloomy, and that possibly the data will, go against what he'd been saying. Now, there have been some good data points out of Canada recently. There's been some strong retail sales. There's been some signs of strong growth, good employment numbers. So, looking at this, for me, the risk is that Governor Pollock is more optimistic. However, against that view is that we still have concerns about global growth. We have the US-China trade war still difficult. We have oil being pressured at the moment, and we've been seeing oil prices falling in the last few sessions. So there's a case for and there's a case against, as often is with trading. But the key thing to be aware of is if Governor Pollock is much more optimistic, we're likely to see some Canadian dollar strength. Okay, so just flag that data point up, be aware of it, look out for it. One potential trade that I'm looking at going into this is the Australian dollar Canadian dollar pair. Now, I had been interested in this pair. I tried to sell this pair last week on the diverging narratives that I'll show you how I did this. On the diverging narratives that were taking place. Now, let me just. There we go. Okay. We got it. I'm just pulling up on the other screen. Now, the diverging narratives that were taking place is we were seeing some weakness in the Australian dollar, and then we're starting to see some strength in the Canadian dollar with the strong retail sales. I knew that the Bank of Canada's rate statement was coming up. I could see them being slightly more bullish than they had been before. Okay, so this is how I tried to short the Australian dollar Canadian dollar pair using this trend line, and I'll show you again how I tried to do it. You can see that trade was wrong. I was stopped out just as price moved above the 100 exponential moving average. That's where I had my stop. I entered around there, had my stop just above the 100 exponential moving average, and was stopped out. However, one trade that I'm looking at is a return to this resistance level up here, the 0.93500 level. I think that there's risk for the Canadian, for the Bank of Canada to be more optimistic about the currency going forward, about the state of the Canadian economy, and the Australian dollar is likely to still be weighed on global growth concerns, as well as the increased expectation of a Reserve Bank of Australia rate cut coming up at their next rate meeting. So these twin expectations of expecting a more bearish Reserve Bank of Australia and a more bullish Canadian dollar pair, this is a kind of, selling the rumor, buying the fact kind of trade. Well, the rumor is that the Bank of Canada is going to be more bullish and the Bank of Australia will be more bearish. So selling from 0.93500 makes sense to me, and with my stop just running just around this, just underneath this 0.9400 level. So I've got a quite a big stop on that. I could perhaps bring it tighter. I could perhaps bring it down to 0.93 80, something like that. Would be another, 0.9380, and then I'm trying to play down back to this level and trying to either bring my trade to break even at the Bank of Canada rate statement for tomorrow, or just take profit before the rate statement. So that's something that I'm looking at there. It's like diverging outlooks that's really interesting me. Okay, so that's the Wednesday. Going into Thursday, again, we have a little bit more New Zealand data. we have prelim GDP, and we have Governor Council Wilkins speaks. Just a learning point again for this is, look, when you've got a central bank speaking and giving a rate statement on Wednesday, as we have here at 3 p.m. GMT time, then when it comes to the Governor Council member Wilkins speaking on Thursday, that's a potential to either correct the market if the bank think it's on the wrong thing, or to confirm it. So sometimes, you know, a central bank will do this. They'll have the rate statement, and the next day there'll be a speech. And in that speech, traders are looking to see for confirmation, affirmation, or some kind of indication of what the central bank is thinking about the market's reaction. So that's just a learning point. Be ready for that. And of course, the crude oil inventory figures are coming out as well. Looking at Friday coming up, finally got the GDP. It may well be that the Bank of Canada has some, might have seen a peak of the GDP numbers coming up. So just to be aware of that. Another big data point is the manufacturing PMI. Now, this is big data for risk trades. And let's just see, do we have the Caixin manufacturing PMI that day as well? I think we've just got the, it's just the manufacturing PMI and the services PMI coming out. Now, a big concern about the US-China trade war has been a slowdown in global growth. Now, what has been fueling that concern has been a slowdown in China's manufacturing numbers. So, above 50 is expansion, below 50 is contraction. If we see a further decline in the manufacturing PMI figures, then we're going to see a further weakness in the Australian dollar. So remember that the Australian dollar is traded as a proxy for the Chinese economy. And the reason is because 30% of Australia's GDP comes from its exports to China. So if China is booming, Australia is booming. And if China is struggling, Australia will most likely be struggling as well. So that's the relationship between the two. That's why the Australian dollar moves so quickly and heavily on Chinese manufacturing data. So just to be aware of that, it's that slowdown figures, slowdown numbers. That's what the market's looking at. And of course, going into this week, we've seen that since the start of end of April, start of May, the US-China trade war has intensified. There's more and more language about trade war in the Chinese language media. And I did read a piece just before I came on today from the Global Chinese Times. I think it was the editor who was saying that there's a real sense now that people in China don't just think that President Trump wants a fair trade deal. There's a sense in which the Chinese people see that President Trump wants to harm the Chinese economy. So I think it's an important point to note, because if the Chinese people and the government perceive that this is a real war, then potentially the hitbacks, the retaliatory tariffs, restricting, for example, China could restrict rare earth metals, which it has a strong access to, and it could get very nasty indeed. So there is a risk that this US-China trade war intensifies and gets even worse. And of course, no one wants to think it could get worse, but unfortunately, unthinkable things do happen. So just to be aware of that. Again, for those who just joined the webinar, remember that the US and China constitute around 40% of the world's GDP. So that's why a war between US and China is considered a global growth problem. What's bad for the US and China is bad, for Japan, Germany, UK, Italy, France. All these countries are interrelated. And as these two countries slug it out against each other, the rest of the countries of the world reels with their punches. So just keep that big picture in your head and in your mind of some of these relationships. So I think it is set to get worse before it gets any better. Xi Jinping, the Chinese president, will want to show he's in charge. He's going to want to show some authority, particularly with Donald Trump being so vocal. He's a charismatic speaker, And I think President Xi will want to show the world, and his own people in particular, that he can stand up to President Trump. And a lot of this is about China's emerging as a more powerful nation. Will they change practices? How will practices done in the past translate into the future, with China becoming a superpower, and how will they take their place on the world stage? The big thing to remember is that the one thing that's holding all of this back really is that President Trump wants to make sure US stocks don't sink. He doesn't want to see a falling US stock market. So when risk does sour and gets worse, keep an eye on the US dollar, Japanese yen, and Australian Japanese yen pairs. Keep a look on those key pivot points. They're going to be key places to sell stocks and trade. It's not stocks, to sell the currency pairs from. Just to be aware of them, particularly for key option expiry levels. Anything like that can potentially provide good selling levels, and obviously the 100 and 200 exponential moving average. Going out of the European morning session, we had the Japanese yen leading the session on the day, obviously starting to be bought up as risk sentiment was deteriorating. European equities were weaker, E-minis were down, we had the number of the yields were down, gold was down 0.4%, and crude was up 0.6%. We saw the fall in the European indices, and overnight there'd been some pickup in sentiment, with the Hang Seng, the Shanghai, the Sensex, and the Nikkei at first had increased 0.37%, 0.38%, and 0.61%. It was up to nearly 1% at one stage, the Shanghai Composite. So we saw Asian equities, having a little bit of relief. That's all been reversed in the European session, with the European equities down, and S&P 500 down, and the Nikkei futures were down. So negative sentiment coming into the market, and the 5, 10, and 30-year yields down as well across the US Treasuries. So there is negative sentiment going in. Look forward, we've already done that over the FX week ahead. Look at the charts. We mentioned the charts. Don't forget the technical places to be looking to enter. 100 exponential moving average, 200 exponential moving average pivot points. These will provide good potential entry points. And again, look at your risk. You don't want to be trading with more risk than you need to. So make sure you use your leverage correctly. And my advice is always not to use too much leverage. In fact, don't use leverage. It really helps your trading. I cover that in some different webinars, and we won't have time to cover that again. They will show you how to use trend lines for entries and stop placements. This can be helpful, and I want to show you how to use trend line. Just plug my battery in. Bear with me one moment. Just keep my power up. Okay, that should be fine. Yeah, that's fine there. Let's see. Yes, now here is a shot I took of a losing trade. Now, I wanted to show you this because it can show you where my entry and my stop was. Now, this was on the 1 hour chart on the Australian Canadian dollar pair. Now, I was biased, and I still am biased to Australian dollar, Canadian dollar pair. And you can see I'm just looking to enter higher now. Now this, if you notice this trend line going from left to right, we had a touch here. 1, 2, 3, 4. So I had 4 touches of this descending trend line. I saw that it was on another test of that trend line, it would be likely that I would get a retest of that level and find sellers on my first test. I also noticed, as you will notice here, that in conjunction with the descending trend line is the 100 moving average. So we can see the 100 moving average here, and here, here, and here, and again here. So I got a good confluence. I had a horizontal level coming across here. So this was a very key point to trade from. So I entered short there. My stop was just above the 100 exponential moving average, and my target was just down here into these support levels down below. My price was triggered in, price was consolidated around this level for a few hours, and then I remember the price of oil was falling. I was hoping that it was going to find support on the 200 exponential moving average, and price continued to fall, and the trade went against me and was stopped out. So just to say that trend lines can give you some very good high probability places to enter, and you can see that just by placing your stop above the place where you know you're wrong. Okay, here this is when I knew I was wrong, and that was a good stop placement because you get price move up above, move up, test, and eventually break through. Now, you know, some traders might say, well, okay, well, with the holding of this trend line, with the trend line being held, I might enter and put my stop below the trend line and play a move up to the 200 exponential moving average. Now, I wasn't doing that because I was buy short Australian Canadian dollar. I like to marry my trades up with a fundamental and a technical perspective. I like to use both. And I'm doing the same here. This is my orders on my account. I'm looking to trade from that pivot point level around the 0.9350, and I've got my stop there about 0.9395, just around 0.9400. So I'm looking to play up to that level and then back down towards the 100 exponential moving average. So that's just you know, an example of trend lines. I'm going to show you another one. Let's have a look. Where did I put it? Here we go. It's finding. So here's the Australian US dollar pair. You can see here, here's a daily line. Got line tested once, twice, 3 times, 4 times. If you go down to the lower time frames, you can see here that, you know, trend line just once, twice, 3 times. So that would be a potentially high probability level to short against that trend line. Price moved towards it, didn't quite get to it there. Price moved to it here. If you'd shorted there, you could have shorted, stop above the 50 exponential moving average, made a place of these lows. Okay, you would have been stopped out, but you see how price reacts to these very clear trend lines. If you take that same trend line down to the 1 hour chart, you can see how price moved up to it, sold off, then broke above. And these trend lines are very, very reliably, technically, you can use them to look at key levels and, you know, go through the pairs and have a look. Just, you know, use them. And also you can extend them downwards as well. Let me show you what I mean. Let's look at the Euro-US dollar pair. Right, let's look at the Euro-US dollar pair. We've got a daily chart there. You can see they can also work as targets. So you can see here how the trend line, see it's 1, 2, 3, 4. That means that to the downside, if that is would be a near side downside target. Okay, so looking on the top trend line here, look, there's a very nice trend line there. You've got 1, 2, 3. So, you know, a place of confluence looking to short the Euro-US dollar pair, you know, high probability area would be around here. It would be here at this 1.13 level. Okay, the 1.13 level. See, the price has rejected the 1.1200 level. If price gets and breaks above there, 1.1300 level would be a very interesting point to sell from. And again, you can put your stops just above the trend line, maybe here, 1.1344, or maybe just above the 200 exponential moving average, 1.1370. Okay, so that's just a quick example of it. Oh, Olafemi is not hearing any sound. That's. Oh, I'm sorry, just someone isn't hearing any sound. I hope the rest of you guys are hearing sound okay. I think you should be. And I think the sharing should be okay. Okay. Okay, well, that's the end of our workshop. We'll be back as per usual next week on Monday. We'll be here on Monday at 12:30 GMT, looking at the FX week ahead like we normally do. And remember that for any money that's deposited, it's $1,500 deposited. You get 1 hour coaching session with me. $3,000 deposited into your account, you get 1 hour session with me, 1 hour trading follow-up review. And $10,000, you get a 2 hour coaching session, 1 hour trading follow-up review, and 1 week VIP support from myself. So that's the offers that we've got on HYCM. I hope you guys have a good week. I hope that was helpful for you. I hope it keeps you informed and keeps you on the right side of the market. Okay, thanks guys. Yeah, thanks Nadir. Take care everybody, and I hope you have a good week. And I look forward to seeing some of you on Monday next week. Thanks and goodbye.